Welcome, my dear students, to Chapter 5, Consumer Credit. What is consumer credit? Credit is an arrangement to receive cash, goods, or services now and pay for them in the future. Consumer credit is the use of credit for personal needs, excludes home loans, home improvement loans, and higher education loans. It is a major force in the American economy. There are three ways consumers can finance current purchases. You either take money from savings, use present earnings, or borrow against future income. And we saw that in the cash flow statements, right? And there are trade-offs involved in using credit. So we start our decisions about opportunity cost or trade-offs with slide number 3. Does consumer credit increase or decrease your purchasing power? A. Consumer credit increases your purchasing power. B. Consumer credit decreases your purchasing power. Or C. Consumer credit has no effect on your purchasing power. Now, in the face-to-face class, I asked this question, and students would have a card or a clicker in some classes. And if you answer A, I ask a student, you answered A, so give me the reason why you think consumer credit increases your purchasing power. But the correct answer here is B, which is that consumer credit decreases your purchasing power. And why is that? Well, because it is not free, right? So why are these people in the business of financing? Is it for the good of mankind? No. They're in the business to charge you finance charge, the cost of the loan. So the finance charge is the total dollar amount you pay for the loan. It includes interest and fees such as service charges or credit-related insurance. Now, the annual percentage rate is the percentage cost of credit on a yearly basis. So now now you are able to compare apples to apples regarding the interest rate. Before, banks and other lending agencies used to play with the interest rate. So some of them include some stuff and the other one don't. So people don't know really what they're getting themselves into. But thanks to the Truth in Lending Act, now if a company is vying for your business and they offer you a loan for 60% and another company offers you the loan for 12%, you know that the 12% is a better deal because now they are using the same method. They are using the annual percentage rate. So that's good. You are comparing like with like when shopping for rates. Now, the Truth in Lending Act also requires creditors to provide you with accurate and complete credit cost, terms, and annual percentage rate. Creditors also must disclose credit terms and information in a clear and conspicuous manner in a form you can keep, but often in a font you cannot possibly read, like the font in this statement below that I borrowed from Professor Payano. So this is where they put all the information they don't want you to read, such as what happens if you miss a single payment, your interest rate goes up to 1000%, and they come and take your house and your firstborn, and you will be in debt to them for the rest of your life, which will not be that long since you will work yourself to death trying to pay the interest, but they don't care because they will have made enough money off you to buy one or maybe even more yachts and brand new gas and barbecue and a trip around the world and. So, dear students, do you read the material they send you before you sign? No, you don't. And they make sure you don't. And they make it so small, it's almost impossible to read. And they say, hey, it's a legal lease and we have to do this and this and this and this. No. If they want you to understand something, they make sure you understand it. But if they don't want you to understand something, they make it very difficult for people to read. So if you're holed up in front of a judge in the bankruptcy court or for whatever reason, do you think that the judge will ask you if you read the material or not? No, they don't. All they care about is that you signed it. It's a legally binding contract, and if you signed it, that's all they care about. So you are going to read those materials, right? It is not easy, and we're going to see some examples in the other presentation. So how do we calculate the cost of credit? We have two methods. The first one is the simple interest. This is the easiest one, and this is what we will be looking at. It is computed on principal only and without compounding. So this is the dollar cost of borrowing. Interest equal principal times rate times time, and time is expressed in years because the rate is always expressed in year. And these are used for most installment loans. They're used by credit unions and for car loans, furniture loans, etc. There is the second method, which is the average daily balance method, and there is a variation of this one. And most credit cards use this method. It uses a weighted average of the account balance throughout the current billing period. Those people, they have sophisticated systems that they know how much you owe them on a daily basis. Okay, now if you carried over a balance, new purchases will be included in your average daily balance calculation, so you do not get to take advantage of the float. Now, what is the float? So some people use their credit card as debit cards, and they pay them off at the end of the month. So they get basically a free loan. This is the float, but we think it's free, but there may be some costs associated with this, and we will see them in a little bit. We will talk here about three other methods that I'm not going to ask you to calculate. It's just for your knowledge here. So there's the adjusted balance method. So new purchases are not taken into account, and all payments are deducted from your previous balance before interest is added. So this is the most favorable to credit card holders, but surprise, it is the least common method. The second method is the previous balance method. It is more costly than the average balance method, but less costly than the adjusted balance method. And there is the two-cycle average daily balance method, and this is the worst method for card holders. And American Express uses this method, so luckily they're not that common. Now, do you remember our $299 iPad? Remember, it cost us almost 2 times more than $299 because of the taxes, depending on your tax bracket. So what if we had purchased it with a credit card and only paid the minimum payment? So let's say the rate was, the annual percentage rate was 19.9%. What's going to happen? The price just doubled again. It will cost us twice as much if we purchase it on credit card and only made the minimum payments. And since those are all after-tax dollars, the true cost of the $299 iPad is almost $1,200. So now, dear students, when you go and you want to buy this iPad, will you be thinking of what we're talking about here? I'm sure you will. Yes, my student will be thinking about this. Now, does this mean that you are not going to purchase the iPad or the stereo or whatever? No, that doesn't mean that you're not going to purchase it, but it means that you are aware of this and you know your options. For instance, that if you invest those $299 for the long run, how much you will benefit. But just be aware of what you are getting yourself into, right? Now, to use personal credit. Use it to purchase a home for higher education or career-related education, because this is good for you, and it's most probably will help you to make more money. And there you can use it also, the personal credit, for home improvement. Now, to use consumer credit. Never use consumer credit. Never use a credit card. But okay, maybe in case of emergency, yes, you can use it. So let's move to slide 11. Try our easy payment plan. 100% down, no monthly payments. It's so easy. Well, yeah, how can it get easier, right? Well, before, when people wanted to buy something like a fridge from Sears, and they don't have the money for it, let's say it costs $700, they would go to the store and tell the salesperson, hey, I have $300, can I give you 300 and you hold the item for me? And yes, so every month they would go and they pay part of the price, and when they pay it off, they get the fridge. This is called layaway. Well, now companies don't do that, of course, because they want your credit. They will benefit by making you sign up for their credit card. It's very convenient, and to them it is very lucrative business. It gives them even more money than the item that they're selling you. So that's why when you go to Target, to Walmart, to Macy's, to all these places, they will ask you, would you like to open a credit card with us? And these people, they do get commissions. So now before you use credit for a major purchase, ask yourself some questions. Could I pay cash or make a down payment? Do I want to use savings for this purchase? Does the purchase fit with my goals and budget? Could I use the credit I will need in some better ways maybe? Can I postpone this purchase? What are the opportunity costs of postponing this purchase? And think of what are the dollar and psychological costs of using credit for this purchase. Remember, it is going to decrease your purchasing power into the future, right? Now, there are few advantages of using consumer credit. Current use of goods and services, it permits purchase even when the funds are low. It is convenient when shopping. Of course, it's very convenient. It's safer than cash. Yes, it can take advantage. You can take advantage of float time. And you may get rebates, airline miles, and or other bonuses. So a lot of people use them even in grocery stores, and it demonstrates financial stabilities. Yes, but still, in my opinion, you should use it for financial emergencies. Now, the disadvantages of consumer credit are that purchases are more expensive, and we already saw that you have a temptation to overspend, it ties up future income, and you might have possible financial difficulties. And the book states this other option or other disadvantage, which is the potential loss of merchandise due to the late payment or non-payment. Well, this would be applicable in a car loan scenario or for furniture, but not for credit card, right? They're not going to take the merchandise you bought. So what are the types of credit card? There are the closed-end credit and the open-end credit. The closed-end credit are used for specific purpose and amount, like mortgage loans, car loans, installment loans, and the open-end credit are like line of credit, revolving credit, credit cards, and home equity loans. And these are used as needed until limit of credit is reached, and you pay interest and finance charges if you do not pay the bill in full when due. We will discuss later the home equity loans, but first let's talk about credit cards. Jonathan Clements, who writes for the Wall Street Journal and other magazines, came up with this name about credit cards: the bubonic plague of personal finance. Have you heard of the bubonic plague of the Dark Ages? Well, it came and it wiped 1/3 of the population, and that's what credit cards do. They destroy your finances. Nearly 8 out of 10 American households carry one or more credit cards. 1/3 are convenience user, which means that they pay their balance off in full each month, and they usually use it to take advantage of points, miles, and other perks. The other 2/3 are borrowers, and a lot of businesses are getting into this great deal because it's very lucrative. So GM, for instance, it used to be that if you charge $25,000 on their credit card, they give you $1,000 off of their card. Now, credit cards and debit cards are not the same, right? The laws and regulations differ. Credit card fraud, if it happens, if for some reason your card is compromised, then the limit you pay is $50 on the credit card fraud. Now with debit card fraud, the limit is $50 if you report the fraud within 2 days. It is $500 if you report it within 6 months. But if you report it after 6 months, you have unlimited loss because you didn't do your bank reconciliation that you learned in previous chapter. Now the truth is that most banks and credit unions will waive the above limit. But if they don't want to, they can. They have the legal right to throw on you unlimited loss if you report a fraud to them after 6 months. So what is the cost of convenience? And this is taken from the Wealthy Barber. But aren't credit card a good way to save money? As long as you pay the total amount each month, you are essentially getting a free loan. Plus, they are so convenient, said Kathy. This is the lady who likes to buy stuff. Not so fast, said Roy. By taking advantage of the float, as it is called, you may save a few dollars a year. But the pennies you save each year are swamped by the hundreds or even thousands of dollars you spent because of the very same convenience you speak so highly of. How many times have you rationalized the purchase of items simply because you told yourself you wouldn't have to pay for it until next month? And then when the bill came the next month, you ask yourself, how did I spend $500? The cost of that convenience is very high. So, true confessions. How many credit cards do you have? 0. Nada? No way, forget it. B. Only one, I swear it. I only use it to buy gas. This was me for a long time. C. Okay, I have two. I use one to pay off the other. And D, more than two, and I lost count a long time ago. Plus, I would not tell you even if I did know. So, which one are you? Also, how much do you owe? A, nothing. I'm serious. I do not owe a cent. Great. B, less than 1,000. C, between 1,000 and 5,000. And D, more than 5,000. Oh my goodness. Now, what is the average credit loan for American? Well, during the 2008 and 2009, during the bubble, the housing bubble, the average credit card household was $9,000. But since then, this trend has been decreasing and people started actually paying off their credit cards. So that's good. Now, if you must use credit cards, then use them like a debit card and pay the balance off at the end of the month. If you cannot do that, then don't use it. If you find that you abuse your credit card, then cut that thing up. So moving now from the bubonic plague of credit cards to the home equity loans. Now these are less expensive than credit cards, but unfortunately for some people they are dangerous. Okay, so home equity loans are based on the current market value of your home less the amount still owed on the mortgage. So assets minus liability equal equity. Remember, they are also called second mortgage, second trust deed, or HELOC, home equity loan of credit. It will be much cheaper than a credit card, yes, and interest is normally tax deductible. Most people can deduct it on Schedule A, but be careful. There is a danger. Peligro. Do not pay your credit cards and you can destroy your credit rating, right? So this is bad, but not a very, very big deal. Now, if you do not pay your home equity loan, then you can lose your home. Now, this is a big deal. Now, during the 2008 and 2009, as I said, people were telling people, hey, what do you worry about? Just get a HELOC, because you know what's gonna happen next year. Your home will increase in value and you'll be fine. And we know what happens, right? So here is an example about a home equity loan. So in this example, the home currently is worth 200,000. You still owe 150,000 on the mortgage, so your home equity is 50,000, which is 200,000 minus the 150,000. Now, a reputable lender would let you borrow up to 75% or 80%, or sometimes maybe 90% of the current value of your home. So 80% of 200,000 equal 160,000. So you take 160,000, you need to subtract from it, you need to deduct the 150 from your existing mortgage, okay? So you have $10,000, so you would be eligible for a 10,000 home equity line of credit. So what do you do with this money? Just use it for emergency. The pipe exploded or the tree fall on your fence or something like that. Use it for emergency because it is dangerous. Now some people they use it to buy a car or for a down payment of a car or whatever because they can deduct the interest. But that's not a good idea. Remember, you can lose your house. So don't do that. Now, some unscrupulous lenders will let you borrow more than the available equity in your home. Have you heard or seen these ads? Mostly in the 2008, 2009. Get a 25% home equity loan. Consolidate your car loans and credit card bills into one easy monthly payment. But what they didn't tell you is run up your credit card bills all over again and lose your house to us when we foreclosed. And it happened, unfortunately, to a lot of people. Now let's take the same example that we had before, but this time with 125% home equity loan, okay? So the home currently is, still worth 200,000. You still owe 150,000 on the mortgage. So the home equity is like before $50,000, which is 200,000 minus 150. Now 125% of 200,000, which is 200,000 times 1.25 equal $250,000. But wait, you still have the mortgage, right? So you deduct the 150,000 and you can borrow up to $100,000. Now, if you used over $50,000 of your available credit, which is only one half of your line of credit, you would owe more than the house is worth. So if you got into financial trouble, you would be tempted to do what? To simply walk away from your home. That's why, guys, I tell you, be very careful with the home equity loans. Okay? Now, what are the sources of consumer credit? Now, the book lists one of the inexpensive loans is when you borrow from parents and family members. I say don't even think about it. It's, you're seeing those people all the time. There's a relationship with them, so be careful, be careful. There might be some cases, maybe if you want to have money for a down payment on a home, and we will talk more about this in chapter 7, then maybe it's not a bad idea to borrow, but we'll see. Those inexpensive loans are another type of them are based on assets such as savings accounts, car, furniture, and they usually should have a lower interest rate than an unsecured loan. And also they have a good advantage is that they help you build your credit history, okay, and increase your credit score if you pay on time. And we'll talk about this later. Now, if you want money, where can you go to borrow money? My preference is to go to credit unions or commercial banks, and those are called medium priced loans. Then there are the credit cards, the cash advances, the retailers such as car or appliance dealers, and those are expensive loans. Now, the car dealers sometimes give you really, really good deals, but you should have a very good credit score, right? In order to get a good deal. But then when you have this, they wouldn't give you, you wouldn't qualify for the $500 rebate or any other perks they might offer. They wouldn't give it to you. So these are some of the sources of consumer credit. So secured credit are loans based on assets called collateral, like your home or car or furniture. And unsecured credit is virtually everything else, credit cards and revolving credit. Those are unsecured credit. So if you don't pay, can they take your house, your car, and whatever? No, no, they don't bother. They just write it off, but it hurts your credit of course, so you need to pay attention. Okay, so with secured loans, this ability to create secured loans, it gives us a tremendous opportunity, really. So an excellent way to begin building your credit is to obtain a secured credit card. So as I said, this is an excellent way to do this. So what do? You go to the bank, you deposit $500 in a saving account, and they give you a credit card with a limit of $500. So you use the credit card, you use it, $50, $100 a month, $30 a month, and you pay it off every single month. Okay, and make sure that the issuer reports your credit usage, and all of them will do that. So within 6 months to about a year, your credit score will rise, and within a year or even less, you will have built up enough of a credit history to get an unsecured credit card. So after you do this, you can then close your account and get your $500 back. Now, what happens if you don't pay off your balances? Well, they will take the money from the $500, and on top of that, they will hit you with charges and penalties and all of that, and you will ruin your credit score. So please, guys, pay off your balance at the end of each month on time. Now, before you take a loan, I suggest that you ask yourself, can you afford the loan? What do you plan to give up in order to make the payments? What is the opportunity cost, the trade-offs? And look closely at your debt payments to income ratio and debt to equity ratio, because the banks have their system calculate this automatically, and you are going to learn here how to do this. So let's start with the debt payment to income ratio. So you take your monthly payments, not including housing, and you divide it by your monthly after-tax income. Now the book says that less than 20% is the preference, but I think this is really, really high. It should be, your debt ratio should be much less than this. So this is an example. You take your monthly gross income, 1,500, you take out, you deduct all your taxes, the Social Security, Medicare, your monthly IRA contribution, and you get your monthly net income. Also, you calculate your monthly installment debt payments. You know, your Visa card, your MasterCard, your Discover card, $15, your auto loan, $153. So your total monthly debt payments are $213. So 213 divided by 1068 gives you the debt payment to income ratio, and it is 19.94%, which is, as I said, high, but some people don't have a problem with that, but it is a high ratio. We move now to the debt to equity ratio, and this is total liabilities excluding also home value and the mortgage, and you divide it by net worth. Now the book says that it should be less than 100%, and I think that this is very, very high. Businesses try to keep it down to between 30 and 50%. And we have an example here. So you take your assets, excluding the value of your house. So your car, 8,000, furniture, computer, miscellaneous. So your total asset excluding a home. So this is your equity without accounting for your house. And you have $12,000. Okay. Your liability, which is your debt, also excluding the home mortgage, is the auto loan, the MasterCard, the Discover card, the American Express. So your total liability excluding the house is 13,000. So the debt to equity ratio is 13,000 divided by 12,000. So it is very, very high and doesn't look good at all. Okay, so we will end this presentation with this, and it happens a lot. Somebody comes to you and tells you, I went to the bank or the credit union to get a loan, and they said they wouldn't give me one unless somebody signs or co-signs with me. Would you please co-sign for me? Well, I don't know, but I don't know if you want to co-sign, but before you do that, I want you to consider this. If a person does not pay, you will have to pay. And you have to ask yourself, can you afford to pay if the person does not? It will affect your credit report as well as theirs if they don't make the payment, and if you don't make the payment when they don't make the payment. You need to request that a copy of overdue payment notices be sent to you so you know what's happening. And you know what? 3 out of 4 cosigners end up paying anyways. So I don't know if you want to do this, but in my class, I tell my student to practice saying, no, no, I cannot co-sign your loan. Okay, just say no. So here we go, students. We have finished the first part of the presentation, and we'll see you in the next one.